You know that chart on your screen? The one you probably check, I don't know, a dozen times a day? All those green and red lines? It feels so modern, right? So simple. But what if I told you that chart has a secret history? One that's packed with pioneers, rebels, and a knockdown, drag-out fight for the very soul of Wall Street.
Okay, so let's just dive right into it. We see these things absolutely everywhere. They're the language of the market. But if you ever stop to think, where did this whole idea of plotting price over time even come from? Well, the answer is going to take us on a journey much, much further back than you'd probably guess. Believe it or not, long before we had computers or even electricity, people were trying to chart markets. We're talking 17th century Amsterdam, where diamond merchants were plotting prices. Then, a century later over in Japan, a trader named Homa Munehisa was charting the price of rice. And in the process, he invented the candlestick patterns that we all still use today. It's amazing. But for our story, the modern story, it really kicks off in 19th century America.
Right. In that story, it really begins with one man, a journalist of all people, who'd end up giving us the very language we use to talk about the market today. His name was Charles Dow.
Hey, Dow wasn't a Wall Street guy. He was a reporter. He and his partner, Edward Jones, yep, that Dow Jones, started a tiny little news agency in a basement near the New York Stock Exchange. They started publishing this daily newsletter, which, eventually grew into something you might have heard of, the Wall Street Journal.
Now, here's what's so brilliant. To measure the health of the economy, Dow didn't just look at one number. He created two different averages, one for railroads, which were like the big tech of their day, and another for all the new up-and-coming industrial companies. His theory was simple but powerful. He believed that for a real, healthy bull market to be happening, both of those averages had to be moving up together. It just makes sense, right? The industrials make the goods and the railroads ship them. You can't really have a sustainable trend in one without the other. And that core idea, that concept of confirmation, is something traders still argue about and use to this day.
So after Dow passed away, his ideas didn't die with him. In fact, they became the bedrock for a whole new way of looking at markets. A new generation of thinkers picked up that baton and they just started running with it.
And wow, what a generation this was. You had Richard Wyckoff, who gave us the language of market cycles. Accumulation, distribution. R.N. Elliott, who found these incredible wave patterns that seem to follow natural laws. Edwards and McGee, they literally wrote the Bible on chart patterns that's probably still on traders' desks today. And of course, Martin Zweig, who gave us phrases we all know, like the trend is your friend. These aren't just names in a history book. Their work is the foundation for countless trading strategies people are using right now.
All right, now let's jump forward to the 1970s, because this growing field wasn't just about developing cool new ideas. It was about to enter a fight for its very survival against a very powerful establishment.
By the 70s, Wall Street was all about fundamental analysis, digging through balance sheets and income statements. The technicians, the people actually studying the charts, were often treated like second-class citizens. And this wasn't just some friendly debate. It really affected who was seen as a credible voice in the market.
And I mean, this was not a quiet disagreement. The academic world was openly hostile. In his massively influential book, A Random Walk Down Wall Street, Burton Malkiel just dismissed the entire field with one brutal comparison. He said technical analysis was like astrology. Ouch. Now that insult, it was backed by a really powerful academic theory called the efficient market hypothesis. The basic idea was that all known information is already reflected in a stock's price, so looking at past patterns on a chart to predict the future is completely and utterly useless. So, feeling kind of isolated and under attack, these technicians did what any group would do. They organized. In 1973, pioneers like Ralph Campora, John Brooks, and Robert Farrell got together and formed the Market Technicians Association, or the MTA. They had to build a community and fight for legitimacy. And that long-simmering conflict, it finally boiled over in the early 2000s. After all the big accounting scandals like Enron, a new set of regulations threatened to basically make technical analysis illegal as a profession. This was it. This was their final showdown. So, a new law called the Sarbanes-Oxley Act created a new certification exam for every single research analyst of the Series 86. And here was the problem. The test was 100% focused on fundamental analysis, not a single question about charts. So the message was clear. Pass this test or you can't be an analyst. Their entire profession was facing extinction. The MTA had one shot. They managed to schedule a meeting with the SEC and other regulators to plead their case. They had to prove, once and for all, that what they did had real, tangible value. So what on earth was their killer argument going to be?
Their argument was pure genius in its simplicity. At one point, a regulator asked them, "What is a fact on your charts?" And they had this devastating answer ready. Price. Price is a fact. Earnings, the bedrock of fundamental analysis, that's just an estimate. Companies restate their earnings all the time, but you never, ever restate the price chart.
And you know what? It worked. In February 2005, the SEC actually agreed with them. They created a special exemption. If you passed the MTA's own rigorous set of exams to become a Chartered Market Technician, a CMT, you were officially recognized. It was a massive, historic victory. And it matters to all of us today because it validated an entire school of thought, giving everyday investors more trusted tools to work with.
That victory was the turning point. I mean, it didn't just save a profession. It launched a global movement. It transformed the MTA from this small tribe of rebels into a true standard bearer for the entire industry.
And just to give you some perspective on how far they came, you have to look at where they started. When the very first CMT designations were awarded way back in 1989, how many were there? Just 19. 19 charter members. A tiny group with a huge, revolutionary idea.
And from that group of 19, the organization just blossomed. Today, it's the Global CMT Association, credentialing thousands of analysts from New York all the way to Mumbai. They hadn't just survived, they had created a global gold standard for their profession.
So from the rice traders of ancient Japan to a dramatic showdown with the SEC, the simple stock chart has had one heck of a journey. Its pioneers fought for decades just to get a seat at the table. Their victory ensures that today anyone with an internet connection has access to these incredibly powerful tools, which really just leaves us with one final thought. Now that the fight for legitimacy is won, what's the next frontier for this field?